Good afternoon. My name is Olin Nochumson, and I'm here with Natalie Klyashtorny and Sherry Lemonick, and we're here today. Well, first of all, welcome to the law firm, Sherry.
Thank you very much. Glad to be here.
So we wanted to introduce you to our audience. So we want to talk today about like 4 different items. The first of which fall within what you're going to do for us and our clients. First of which is PPP funding. So as we know, there were 2 rounds of PPP funding. We're in the middle of round 2. The funding was to help small businesses during this pandemic, and we're in the middle of round 2. And so I want to talk about. Everyone's talking about getting the money. I want to talk about first, have an overview of what the program's all about, but then how do we properly spend the money, or how our clients properly spend the money?
Okay, well, thanks, Alan, and thanks for having me. So in connection with the PPP program, and there's a number of other programs, but we'll focus on PPP. So in obtaining the funds, as you know, the amount that each borrower was eligible for was 2.5 times the average monthly payroll over the past 12 months. So for those that qualified and were lucky enough to receive it, that's what they got. They now have a choice with those funds. They can keep it as a loan, use it for whatever they want, in which case the loan will bear interest at 1%. There's a 6-month deferral period in which you don't have to pay back anything, principal or interest. And then after 6 months, you have to start repaying, and the loan has to be paid over a 2-year period. Cheap use of funds, okay? If, however, you want to go down a different road, if you qualify, as I'll explain in a moment, that loan can be forgiven in total. So it basically becomes a grant from the federal government. In order to qualify for the grant, you have to use 75% of the amount of the loan for payroll and payroll purposes, payroll costs, which include the employer portion of FICA. Okay. You have to use that money during an 8-week period that begins on the date you receive the funds. And that's been a big issue of concern because many businesses are closed. So how do you give your payroll and hire people back when your business isn't even allowed to open? So that's been something that a lot of people have been talking about in the industry, especially in the restaurant business. So the other thing is that normally under federal income tax law, when you have a loan that is forgiven, it's called forgiveness of indebtedness and it's income. In this case, if you comply with these rules, you will not have income.
Gotcha. So what about the other 25%? Like because you said 75% has to be used towards payroll. Is there a mechanism to use the other 25%?
Yeah, most people, the rules require you to use the rest you can use it for rent or mortgage if you have a mortgage, as well as your utilities.
Okay, so if someone had got like $100,000 in terms of a loan, then 75,000 would have to be used. At least 75,000 would have to be used towards payroll, and then 25,000 would have to be used to whether it's rent, a mortgage, or utilities, right?
Yes, and let me talk just for 1 second about the 75,000. So many businesses who have applied for this have laid off their employees. So they say, okay, I have a $100,000 loan. I want to get it forgiven. I have to pay 75,000. So you call up your employees, who many of them, if not all of them, are collecting unemployment, and you offer them their job back. Whether you're open or not, you offer them the job back. One of the glitches here is that some people are making more money on unemployment. And so they say, well, no thanks, not until you open. I want to keep my unemployment. First of all, from an unemployment perspective, if you were offered your job back and you turn it down, you are at risk to lose your unemployment under state law. Under federal law, though, if you have an employee making X dollars per year and you offer to bring them back and they say no thank you, you can still count that amount that they would have gotten in the 75%. You're not penalized because the person chose not to accept your offer to come back.
Okay, so if you hypothetically ask your staff to come back in a restaurant, because I know that's the biggest issue, because people are collecting more in unemployment than they would collect if they're working. But if you offer to make, to employ them again, as long as you make that offer and it's declined, can you say that you've actually spent that money for purposes?
Yeah, it counts, but the offer needs to be in writing.
Okay.
So you should make sure it's in an email or something that you can justify.
All right. Well, that's actually really important. So, and again, just to reiterate, it's 8 weeks from the time you got the payment. So if we got the payment today, which is May 6th, you would have to spend that money on or before July 6th.
Correct.
Okay.
And we're hoping to get that language changed, because for something like a restaurant, what the language really should say is 8 weeks from the later of the date you get it or the date you reopen for business in accordance with applicable law.
Yeah, we were talking about that before, about that like New York Times article this weekend, where a lot of businesses were hesitant to spend that money because they're not open. They want to actually use those funds either as a nest egg when they do open up, or for, purposes of, maintaining their business. But right now, if they can't open up, it's wasteful money to just pay people to do nothing. So
I think we'll see some changes to the law coming out pretty soon in that area.
Okay.
Sherry, what about banks are tightening their lending now because of what's going on. If I bought a property and I want to renovate it, and I'd like to get a construction loan, what are some other options that would be available to me other than going to a traditional bank?
Okay, great question, Natalie. So many of the banks that I'm seeing that normally do construction loans, it's not that they've stopped, it's just that they're so busy with the SBA loans that they just can't even focus on this. So you have a couple of options. You can go and borrow from what we call a hard money lender, which is basically an individual or a partnership or an entity, a non-bank that will loan you the money. They often work a little bit quicker. They don't have a lot of the regulatory requirements that banks have to go through in the lending process, but you will pay a higher interest rate in the world of hard money.
Sure.
You can also, depending upon how much money you need and what your portfolio looks like, you can offer equity. You could try to raise more equity. Now, one of the good things about taking money in the form of equity is that you're not paying current interest. So when, let's say you needed $1 million for construction, the minute you get that $1 million, usually interest starts to accrue. Now, you may not have to pay it. It could be deferred until you're taken out on your permanent financing, but the clock is ticking on the interest rate. With an equity investor, they put their money in and they don't often expect to see any return until the construction loan is taken out or the property is sold. So you could be saving yourself some cash during the construction build phase when you're not generating income in the first place. It also could end up, depending upon what deal you strike with your equity investor, being cheaper than the rates, the hard money. Hard money rates are going at 15 and 18%. So on the other side, if you're building your property out and you think you're going to be able to sell it at a nice windfall, giving somebody equity, you might be giving up a bunch of upside. So it really depends on your numbers.
Yeah, and,
right.
and from my experience, like representing real estate investors, when you compare hard money, how much it would cost an interest rate versus how much the preferred, interest for an equity deal, it's actually better in some ways for the preferred equity, right?
Yeah, so there's two parts here, Alan. So let's say I'm a hard money lender and I lend you $1 million. You're going to have to pay me back the $1 million plus 15%. Let's just call it a year. So it's going to cost you $1,150,000, but then I'm gone. If I gave you $1 million in the form of equity, the pref rate or the preferred rate of return might be something like 8%. So that could be 80,000. And when the property's sold, right, I get my 80,000 plus my $1 million, but I then also get a piece of the profit.
Gotcha.
That would have otherwise been yours. So in a debt world, once you pay your lender back the principal and interest, the rest is all your gravy. In an equity world, you pay me my pref and my capital, but then I get to participate for a certain percentage of the profit. So you might be giving up some of the upside.
So if one of our real estate investor clients came to us, like how do you set up one of these deals? Like in terms of private financing, like what's the bones of a deal like this?
The most common way that we're doing it, it used to be limited partnerships. For many, many years, 90% of the real estate deals you saw were in the form of limited partnerships. You would have a limited partnership, the LPs would be the investors, and the general partner itself was an LLC, and they got what was called a carried interest. Now what we're seeing are limited liability companies. When the investor comes in, they become a quote member, they get an LLC interest. We do more than one class because the investor usually has non-voting equity, and they just get a pref their capital back before any distributions are made to the others, and then they float along for the ride. Now, let me say this, even with an equity investor, it's very rare that you're going to get somebody who's going to put all the money up without some collateral, right? So you're going to need some form of a guarantee or something to know. So for example, let's say you had a construction project, okay, that was $1 million. In the banking world, if our banks were not so busy, the bank might say to the person, the developer, put up 200,000 and we'll give you the other 800. We want to see 20% equity in the hard money thing, you're still going to have to come up with the equity, okay? And if you go with true equity, then again, most investors are going to want to see the developer put up some of their own money because they want to see some skin in the game.
Mm-hmm. Can anyone, like, is there any limitations of who can be an investor?
Yeah. So we have securities laws at both the federal level as well as the state level. The state we call blue sky laws. Mm-hmm. At the federal level, theoretically, anybody could be an investor. Mm-hmm. But if we have a definition under federal securities laws called an accredited investor. And what an accredited investor is it's a person who either meets one of two tests. One is called the net worth test, which means that your net worth, exclusive of your primary residence, you cannot include your primary residence when calculating your net worth. Mm-hmm. So your net worth has to be $1 million, or you can meet the net income test, which means either you made $200,000 last year alone, if you're solo, or together with your spouse, 300. If you meet either of those two tests, you are an accredited investor. And if you are an accredited investor, then the company can issue equity to you. And when I say equity, it could be stock, limited partnership interests, LLC interests, whatever is the entity that you're putting your money in, they can issue equity to you without registering the sale of those securities. Now, having said that, it is the obligation of the company to make sure that that investor is in fact accredited in order to fall within an exemption. And in order to do that, you issue what's called an accredited investor questionnaire that you need to have every investor sign.
Okay. Are there any governmental filings with regards to this raising funds?
So there's something called Reg D, which is not required, but it's what's called a safe harbor. Mm-hmm. If you file a Form D with the SEC, which lists all your investors, their addresses, where they're from, and how much they're putting in, if you file a Form D within 30 days of the sale of the security, there is a presumption that you complied with Reg D and that it is now a private placement, and a private placement does not have to be registered with the federal securities laws.
And what happens if an investor doesn't do things the right way by submitting these governmental filings?
If you don't, it's not illegal that you didn't.
Yeah.
And if the project goes great and everybody gets their money, you'll probably never have a problem. Mm-hmm. But if the project goes south, mm-hmm. and the investor doesn't get back their money or the return they thought, and they sue you, what they're going to say is, I didn't know. I didn't know that risk.
That's right.
And then they're going to say, and the federal securities laws, you start with the general rule, Alan, and the general rule under the Securities Act of 1933 says it is illegal to sell or offer to sell a security unless it is registered with the SEC or you have an applicable exemption.
Yeah.
So putting aside the fact that Mr. Investor didn't get their money back, if you sold a security, which is an LP interest or an LLC interest, and you don't fall within an applicable exemption, you have violated the federal securities laws.
Yeah.
Which there are civil fines and criminal fines.
Yeah. We've seen it. We have clients, who come to us afterwards who are like, oh, we've always done it this way. We get money from our friends and family or college roommates. And, if things go well, fine, but we always tell them to do it the right way, to get the paperwork together, to get the private placement memo together, to get the governmental filings together. Because in case a project goes sideways, hypothetically, if you have a pandemic, which messes things up, then you have the civil and criminal penalties.
Yeah, and even if you don't want to go with a full PPM, which is a private placement memo,
Mhm.
at minimum, when your investor puts money in, they sign, I always get an accredited investor questionnaire.
Mhm.
I also have them sign a subscription agreement where they represent and warrant that they are an accredited investor,
Mhm.
that that the company is relying on that representation and selling them securities, that they're able to bear the financial risk of the loss of that money. I also put an acknowledgement in by the investor that says, I have read all the risk factors set forth on Exhibit A here too. And you attach to the subscription agreement an exhibit called risk factors, which is a piece of what's often found in a PPM. And that list, and it's very negative. It's written purposely in the negative. And often even companies don't like to do it because they're afraid they're going to scare off their investors, because it tells every doomsday. We might not be able to raise enough money. It could go bankrupt. The world could be set on fire. You could lose your money. There could be an epidemic that comes out of Wuhan, China, and you could lose your money. It's every negative so that you can never say, I didn't know.
So you had actually a risk factor about having a pandemic coming out of Wuhan, China.
Sherry, with so many businesses being shut down now, unfortunately, a lot of businesses are coming to a situation where they're not able to meet obligations, or they can't pay their loans back. What are some of the options that are available to them under the circumstances?
Well, we're starting to look at restructuring a lot of borrowers' loans. Most loans that you will see are secured with some type of collateral, often real estate that, the three of us work on a lot. And at the end of the day, you have to know that the banks really do want to work with you. They don't want to foreclose. Because if they do, they're going to have to go through all the legal hassles of foreclosing. Then they're going to own your property. They don't want to own your property, especially if the property is rented out. Banks don't want to be landlords. And then they're going to have to sell it at an auction to repay their debt at, cents on the dollar. So the bank's goal is really to get themselves repaid and work with you. And so what we're doing is we're restructuring loans to the extent that rates are down, which they're very, very low now. You might be able to get a lower interest rate on an amended and restated loan, or we're spreading the payments out. So what would be a 3-year loan could now be a 5-year loan, which would reduce the amount you have to pay every month. I'm also seeing banks say, well, for the next, X number of months or until you open up, we'll defer, not waive, but defer your monthly loan payment. And then when you open up, we can either add it to the back of the loan, or we can spread, the 3 or 4 months you didn't pay over the life of the loan.
Yeah, we did that recently for a client with Univest, where he deferred the interest and principal payment, and he added the interest to the end of the loan on top of it, and then he extended the loan out for a couple of months.
Yeah, and the best way to do that is with a new amortization schedule, which the bank will calculate for you.
What would you recommend if, unfortunately, your bank's not willing to work with you?
If the bank's not willing to work with me, the first thing that I would do is I would look at the value of the property and the amount of the loan. So let's say, for example, I owed $1 million to a bank, and I have a property that I truly believe is worth $1.5 million. So there's $500,000 of equity in it. If I can't afford to make that loan, I would try to sell the property so I could pay the bank back and not lose my equity. On the other hand, if I owed the bank $1 million on a loan and the property's worth less than $1 million, I'd hand them the keys.
Right.
That's right. And the point is too, is not to put your head in the sand, right? So I think the banks are understanding in this environment. We see a lot of our clients or, people after the fact where it's been months that they've been dealing with this or not dealing with this situation. And we always tell them to hit it head on. And especially in these unique times, go to the bank, address the situation, see what you want to do. And like you said, Sherry, these banks don't want to put it on their balance sheet that they have bad loans. It affects their ability to actually lend funds in the future.
The one thing I think that clients should know is, let's say for argument's sake, you have a property and it's worth $800,000. So it's what we all call underwater.
Mhm.
And you say, even if I sold it for 800, I still have a shortfall. So here, Mr. Lender, here's a deed, and they take a deed in lieu of foreclosure. That does not let the borrower off the hook for the 200,000.
Right.
Unless you do a short sale and the bank agrees to forego the deficiency, the borrower and possibly the guarantors, because you usually have personal guarantees, are still on the hook for the shortfall. And I think people need to be cognizant of that.
Well,
Right.
but we dealt with one in Reading, Pennsylvania, a significant foreclosure action. But a lot of times the guarantees are like non-recourse, and there's carve-outs, for bad deeds, right? So a lot of times you'll have the guarantee as long as the borrower didn't pay because they couldn't afford to pay. It would be different if, they had the ability to pay, but they chose not to pay, right?
Well, that's if you have a bad boy guarantee, right? You could have a regular guarantee,
Right.
like the mutual client that we have, Alan. They're unlimited, full personal guarantees.
Did not know that because you handle the banking. I would recommend.
Bank doesn't get paid by the borrower. Our client's on the hook personally.
Did not know that. So yeah, so that's one of the things that if in actuality, like we would look at, like if someone came to us, before anything, obviously we would have to look at the loan documents and see the exposure of not just the borrower, the corporate entity that owns the property, but any guarantors. Mm-hmm. So it does change the equation when you have unlimited exposure versus limited exposure.
Yeah, the other thing that I would also say that I'm working on with our mutual client is oftentimes when a bank lends money to a borrower, and our borrowers are usually SPEs or special purpose entities, set up an LLC, which our client does, buys a piece of real estate, borrows money from the bank, and then the principals guarantee it. Okay. So we have a number of situations where you have personal guarantees of 2 or 3 people. Okay. All of those guarantees are joint and several. The borrower goes down and doesn't pay the bank's going after A, B, and C on those guarantees. They're not going to go after one, they're going after everybody, right? If one of them has a deep pocket, the reality is the bank's going to get paid by the person with the deep pocket.
That's right.
That person will be on the hook for the full amount, not a third.
Right.
That person has no right of recourse against the other two because he or she got called up, unless you have a contribution agreement that says Alan, Sherry, and Natalie are all guaranteeing. But because Alan has the deep pocket, if there's a call on the guarantee and Alan pays more than 1/3, he has a right of contribution against Sherry and Natalie for 1/3 each. I think that that's important.
Yeah.
You do otherwise, Alan, you could get hit for the full thing and you've got no basis to sue Natalie or I.
So a lot of times, again, when we look at, when we called in for our clients, like we work 7-figure deals all the time. And a lot of those deals from a loan perspective are done on Laser Pro. We're actually doing a $2.5 million deal on Friday where the client decided or allowed the bank to do a Laser Pro document. So there's not much leeway. So and this is a good segue to the last topic about corporate formation and corporate restructuring. So if the bank documents don't account for some of these differences between the members or the partners, it sounds like the corporate document should, right? So for instance, if you're forming like an LLC and they're members, it seems like there should be provisions in there for contribution, right? Between the parties.
Yes.
Not everyone's created.
You should have these provisions in your LLC operating agreement if you're an LLC, or a shareholders agreement if you're a corporation. But I want to go back, Alan, to something you said. You're right. These Laser Pros are forms. Yeah. But I never accept, if there's something I don't like and I have to live with it, as long as your client understands the risk. But I have seen provisions in the Laser Pro that I just can't live with. And I go to the bank and go, no. And they will cross it out or change it.
Yeah, I mean, there are some things.
Right? So there's one provision that I see all the time in the Laser Pro. In the event of default section, where you talk about what's a default. The default is if you don't pay on time, right? A default is if your reps and warranties are not true, or you fail to fulfill a covenant, or you file bankruptcy. I'm okay with that. They have an event of default, quote, if the lender deems itself insecure.
I know. I've seen.
Yes, I've seen that a lot.
Okay, no.
Yeah, by the way, the other one that I've seen a lot too, and that kind of goes to the corporate restructuring, is that if you change the interest amongst the members, technically you would need the bank's permission.
If it's a change in control, yeah.
That's right. So,
Yeah.
so let's go to the corporate formation and
Okay.
structuring, because these are a lot. So, raising funds, how they do the PPP, like, loan modifications. These are all things that our clients are looking at right now, and people who may be our clients. So, but I think the biggest thing is when you have a pandemic like this, where everyone's stressed out, there's going to be like a change in, how people are going to do business, right? The partners may not be partners anymore, or they may bring on other people. So like when someone's coming to you, say, we'll talk about restructuring later on, but formation, what are the things you talk to them about initially?
First, I talk to them about what form of entity we should have. 95% of the time, it's going to be an LLC or a limited partnership or a sub-S. Reason, all three of those are what we call pass-through entities.
Mm-hmm.
A new client that I'm working on with now is actually a C Corp. You don't see as much, but there are certain types of investors, not individuals, but corporate and pension funds that are not permitted by law to invest in pass-through entities. So if you were raising funds and the New Jersey State Teachers Pension Fund was going to invest $5 million in your project, it would have to be a C Corp.
Mm-hmm.
Okay, but usually we're doing LLCs. The next thing is what state. I recommend the state in which the property is located or the business is located. The next thing is I ask what the business deal is. If the property is sold, does the pref go first? Do people get their capital back? Does the general partner or the Class A founder get a carry? You look at the business provisions. And then you look at the relationship among the parties. So, for example, here's something that I've been telling a lot of people that they go, huh? So in an LLC operating agreement, we have something called trigger events. And the trigger events are a list of events. And if any one of them happens, the company gets to buy you out.
Mm-hmm.
Let me give you an example, Alan. You, Natalie, and I form an LLC, okay? I'm single. Natalie, you're single, right? And Alan, are you single?
I'm married.
Married, sorry. Okay. So Natalie and Alan are both married and I'm single, okay? And you guys each own your equity as a married couple.
Mm-hmm.
I own mine singly, right? Alan gets divorced. His units in this LLC are a marital asset.
Mm-hmm.
His
Right.
wife can claim 50%. Natalie might say, we don't want nothing against Alan's wife. We don't want to be in business with her. So you need a trigger that says the company gets to buy back the shares so that they don't become part of the divorce.
Interesting.
Yeah, and there's other buy-sell provisions as well, right?
Right.
And then you talked about the contribution. Again, we're not all created equal. You may be the front person. You may be the brains behind the operation, and we may just be the investors, right?
Right.
So, again, there'd be a contribution. Like, we shouldn't be on the hook if this thing fails, right? Like, you should
Right.
ultimately be on the hook.
Right, and as a matter of fact, on one real estate developer, a client that we share, there are 3 guarantors that guarantee this debt. The reality is, if God forbid it went south, there's one that has a deeper pocket that we all know will be hit.
Mm-hmm.
It is not uncommon for that guarantor to ask for a guarantee fee that says, we're all signing, but it's really my wallet that's on the hook.
Mm-hmm.
And so I want a fee for taking that risk.
Gotcha. And then also, who's going to manage the entity too, right? So for an LLC, there's membership management, and then there's manager-based management, right?
Yeah, so in a regular corporation, there's no flexibility. It's the board of directors, period, end of report.
Mhm.
In an LLC, one of the reasons we love LLCs is because of their flexibility. You can be member managed, which means all the members, and usually it's by like a majority or a higher vote for certain actions, or you could be manager managed, which is more like a board.
Mm-hmm.
In the event of manager managed, one of the things that I often say is fine, have a board, you put in the agreement who is on the board, okay? So We have a board and we say, Alan and Natalie, you guys are the board. I'll let you go ahead and run the day-to-day operations. But for any of these big things, which we call major actions, you can't do it without a vote of, 75% of the shares. And that would be like sell the property, incur bank debt, enter into a new line of business. You can't do the big stuff without the consent of a higher percentage of the members.
Yeah. And then we actually, I put this in my documents too. If there's an expenditure of over a certain amount too, I'll give you flexibility. I don't want to look over your shoulder, but at the same time, if there's an expenditure that's like $20,000, which is atypical of that business, whatever that amount is, then you would need special approval of all the members or a certain percentage of the members.
Yeah, what I usually do is, because it's hard to come up with that number, right? I usually say, if you spend more than blank outside of the budget, you might write a check for $300,000.
Yeah.
But if it was within the budget that was approved, that's okay. It's when you go outside the budget that you want some checks and balances.
That's right. That's right. And then we form all these entities, obviously, to insulate the individuals as part, who are, whether they're members or partners, from legal liability, who are doing actions on behalf of the corporate entity, right? So now we're in a situation where, say, an entity is formed, and I come to you and say, well, you know what, I'm having money troubles. I need to liquidate a little bit, right? Like, what advice would you give me if I'm coming to you as a client saying, hey, I need to liquidate my membership interest in an entity?
Okay, so the first thing I would do is say, show me your operating agreement or your shareholder agreement, because there's 99% of the time there are restrictions on transferability. If you want, let's say you and Natalie and I have an LLC and you want to sell your units. Most operating agreements, certainly the ones that I draft, say that Natalie and I and the company have a right of first refusal. So first you would offer it to the company. If the company has the money, they would buy you out. If the company does not accept the right of first refusal, it then goes to Natalie and I, pro rata. So if Natalie owns 40% and I own 20%, she can buy double what I can buy. Now, here's where it gets a little dicey. Let's say that Joe Blow comes to you and says, I'll give you $1 million for your units. Cash. And you say, thank you for the offer. I got to go ask Sherry and Natalie. We exercise our right of first refusal because we don't want to be in bed with Joe Blow. But Natalie and I don't have $1 million. It's not uncommon to say that we or the company can purchase them, same price, $1 million, but we only have to put 20% down. The balance we can give you with a promissory note over X number of years, which means you're getting less cash from us than you would have gotten had you sold to Joe Blow, which may not be so good for you, but if it's Natalie or I selling, then the shoe's on the other foot.
So it sounds like if you're doing one, like an operating agreement or a shareholder agreement, you really need to tighten it up in the sense it has to match exactly the same. $1 million today versus $1 million tomorrow are a lot different to people. And I may never get that $1 million, right? The company may go belly up and now I don't have $800,000 while I would have the full million under your scenario, right?
Well, the one thing I do normally say, to be fair, is if Natalie and I, let's say there were 100 units, okay? And you had 40 and Natalie had 40 and I had 20. And so you sell your 40 to Natalie and I, but we don't have the $1 million to give you. We'll give you X% down, a promissory note, but the units that we buy from you, we will pledge as security and collateral to you. So if we don't pay you, you can foreclose under the pledge agreement and get your units back.
Okay. So what other protections, like, because I can understand when you have a small company that's like, like in family held, you want to make sure that it stays within the family. What other protections can a company have when you're dealing with some restructuring, of the business operations?
Well, you can have these triggers, okay, that will prohibit the units from going to a spouse if somebody got divorced. Similarly with estate planning, right? So, not to be morbid, Natalie, you have a will. Your will might leave all your assets to your husband. You pass away, your units pass under your will to your husband. Alan says, no offense, I don't want Natalie's husband to be my partner. So what do? We give the company or Alan the right to buy those units from the estate. Where do you get the money? A life insurance policy.
That's right.
So
And I
people
was
take out cross life insurance policies to fund these cross-buy obligations.
Yeah, I was actually going to go to Keyman Insurance or Key Person Insurance, right? Because if you're the brains behind the operation and you're the person that makes things go, the company would also forget about your errors. Like, to protect the company, there's such a thing called as Keyman Insurance, right?
Yeah, and even like I built a house at the shore last summer with my sister. She and I paid the mortgage 50-50. If something happened to one of us, we're screwed. We own the house joint and several. We're on the mortgage joint and several. So we just took out life insurance policies on each other's lives. So if something happens, the person who survives has the money to pay off the mortgage.
Yeah. Well, it sounds like that's actually probably what a lot of people should be thinking about, especially during this pandemic.
Right.
Morbid, but if someone gets touched by this and, it's going to affect the business operations, they should think about getting life insurance.
Yeah, they should. And the other thing is with estate planning, sometimes people say, now it's not as much of a deal now because the new tax laws have a much higher threshold before you start paying federal estate tax. It's over $10 million. But if you want, a lot of people put assets into a trust. And if you transfer an asset from your name into a trust, it gets it out of your estate for estate tax purposes. I don't have a problem, Alan, with you taking your shares of the Alan, Natalie, Sherry LLC and putting them in a trust for your children, as long as you retain the voting rights.
Gotcha.
Right? So you can put the economic benefit into the trust for your children, but the voting rights need to stay with you, not with your children and not with a new trustee.
Gotcha. All right. Well, I think this is an awesome discussion. We touched on a lot of different things that, people and companies are going to be dealing with, now and, for the not too distant future, right? It was a great conversation. Like, Sherry, we're so excited to have you on board. We think
Happy to be here with you guys.
Yeah, you're definitely going to complement, our practices, and we'll see you in person hopefully very soon.
Yes.
Very soon. Stay safe, guys.
All right.
Yeah, you too.
Bye-bye.
I'll see you.
Bye.
All right, bye.